Thanks for clicking. My name is Mark Mitchell. I'm a mortgage broker here in London, Ontario. Last week, the NDP and their leader, Jagmeet Singh, released their election platform outlining a number of plans that they have to make housing more affordable in Canada. Among those are the introduction of 30-year insured mortgages in Canada. So insured mortgages, that's mortgages with less than 20% down. Right now, it's currently set at 25 years being the maximum. And Jagmeet Singh and the NDP want to change that to a 30-year amortization, not only to make payments more affordable, but also to make qualifying standards a little bit easier for the average Canadian. As we've seen in the past year and a half or so, the prices of Canadian real estate has skyrocketed, locking out a lot of first-time home buyers. So the NDP's idea is that if you extend the amortization from 25 years to 30 years, not only will payments be much more manageable for the average family, but also it'll be easier to purchase a house for the average family as well. So in this video, I just want to go over the calculations briefly and see how much does it actually change the payment, and how much does it actually change what the average family can qualify for. And after that, we'll go over a few of the implications inherent in extending amortizations from 25 years to 30 years and perhaps even further as we go down this road. So to look at the differences between 25 and 30-year amortizations, I'm just going to use a bit of data pulled from London, Ontario, my hometown, just to see what the payments and interest costs would look like. So last month in London, the median home price was $575,000. So half of the houses sold were below that mark and half were above that mark. So we'll use $575,000 as our base home purchase price with minimum down payment requirements of $32,500. That's 5% of the first $500,000 and 10% of the next $75,000, so $32,500. We're going to use an interest rate of 1.89, but qualifying on an interest rate of 5.25 as per the stress test. So if we look at this chart, we see a big difference in the payment between 25 and 30-year amortizations. Almost a $300 difference, with the 25-year amortization coming in at $23.59 and the 30-year amortization coming in at $2,052. So obviously, if you extend the amount of time that you have to pay for something, the payments are going to be lower. So Jagmeet Singh and the NDP definitely are correct. This would lower housing costs for the average family in Canada using that median house price. However, that's where the advantages really end. One of the main issues with 30-year amortizations is that for the first few years, more and more of the money that you pay go towards interest and less go towards principal. Again, if we look at this chart, we can see that on a 25-year amortization, for the first 5 years, you would pay $48,887 in interest, but you're paying almost the same amount, a little bit higher in interest, a little bit more in interest, over the 30-year amortization at $49,766. So you're paying the same amount of you're paying even more interest, even though your payments are less. Well, where's that? The money is coming from principal. If we look at the chart one more time, we'll see on a 25-year amortization, you pay $92,668 of your principal off over the first 5 years, and almost $20,000 less towards your principal if you go for a 30-year amortization. So over 30 years, you'd only be paying $73,379. A big advantage to having rates so low is that when you're only putting 5% down, you don't have a whole lot of equity when you first buy your house. So it's great when you're taking advantage of these low rates to be able to pay it down much, much faster. But when you do extend to a 30-year amortization, you do suffer quite a bit on how much you're paying down your house because so much more goes towards principal. So definitely, yeah, it will make it, extending your amortization to 30 years does make the house more affordable. It makes real estate payments a little bit more manageable for the average Canadian. But over the long term, you do end up paying a lot more money to the banks than you normally would. Speaking of the banks, right now, when you want to qualify for a mortgage with less than 20% down, an insured mortgage, you have to qualify based off 5.25%, that's the stress test, and a 25-year amortization. So just as a test case, if we look at London's average household income, which is $111,250, qualifying off 25 years with 5.25 interest rate, you can qualify for a purchase price of $520,000. However, if we extend that amortization to 30 years using, again, 5.25 interest, you can qualify for $35,000 more at a purchase price of $555,000. So by increasing your amortization from 25 to 30 years, you do pay more in interest. However, you get lower payments and it increases your buying power. So it's important you really have to balance those two things out. You're going to pay less off of your principal, you're going to pay more money to the banks, but you can purchase maybe a little bit more house and your payments are a little bit more manageable, at least for the first 5 years, as you can lock in your interest rate at low 2%, at least right now. As we've seen, one of the big problems with 30-year amortizations is that you pay far more in interest over the first 5 years than you do if you have the amortization right now at 25 years. So that does lead to quite a bit less equity at the end of your term than you would normally have had you have stuck with a 25-year amortization. However, another big problem that I think needs to be considered is that although it does increase your buying power, it increases the buying power for everybody. As we've seen throughout this year, Canadian real estate popped. It skyrocketed, it went through the roof. And there was all sorts of talk about how does the government cool it. Well, the government cooled it by raising the stress test from 4.79 to 5.25. Just in London, that brought down the average buying power from 540,000 to 520,000. So it lowered your buying power by $20,000. If we add in a 30-year amortization, everybody's buying power just goes back up to $565,000. So it erases any of the gains made by the stress test in cooling down the housing market, while simultaneously having you pay more interest and have a smaller amount of equity in your home. So it's really it erases all the gains that we've made this year, and at least cooling the housing market and making our real estate market a little bit more affordable. So I think this is definitely something to be considered going forward if they're going to make 30-year amortizations the norm, is that it will be somewhat, at least going backwards. Going backwards as far as cooling down the real estate market. With that said, that doesn't mean that they shouldn't do it, because as we've seen, the payments are quite a bit more affordable. So it's always a balancing act when you're looking at stuff like this, but I just think it's important to note that there are some positive and some very, very big negative issues included in extending the amortization to 30 years. We've seen more and more 35 and 40-year mortgages become the norm in the United States, and if we're going to go down that road, then I think we need to keep in mind that it involves paying a lot more interest, a lot more money to the banks, and looks like, at least at this point, will only help to overinflate our housing market even more. But as more and more comes out about 30-year amortizations and anything with the mortgage market and the real estate market throughout this campaign, I'll have more videos out. If you do like this video and you want to get more updates, please do click like and subscribe, and we'll have more videos as the news comes out. Thank you.